Anshul Saigal joins us and let's connect with him. And question which I'm asking everybody is that we survived the storm yesterday, but today will we be part of the falling stack? Uh, Anshul bhai, good morning. Thank you for joining us. We've woken up to a
Morning. Good.
provided you slept last night, a lot of us have not slept because trying to understand what happened. The morning cues are bad. US is down, Europe is down, gold is down, and volatility is up. Only thing up this morning is volatility. Yesterday, we did not get hit. We survived the storm. Today, will we get lucky again?
Nikunj bhai, good morning. Always a pleasure. Thanks for having me. I was looking at the 20-year chart, and your screen is flashing Russell 2000. I was looking at the 20-year chart of Russell 2000, comparing it to Nasdaq, the index. If you do that comparison, you will notice that in this 20-year period, Russell 2000, which is the small and mid cap cyclicals, industrials kind of companies in the US, that index is up 5.5 times, while Nasdaq is up 20 times. So the underperformance in the real economy in the US is as much as 5.5 times to 20 times, nearly a 4x kind of a differential in how tech has done and how this segment of the market has done. If you compare the emerging markets to the US, something similar has happened over the last 15, 20 years. Now, what this tells you is that there has been a certain regime in place which has led to this outperformance in a certain segment of the market. First US, second tech, particularly tech in US, and that regime, in our judgment, is changing and changing fast. What we will see going forward in the context of US is that catch up between Russell 2000 and Nasdaq will happen. At least that is our view. And second, given the policy of the US establishment today, wherein they believe that their currency has appreciated at a time where their current account deficit has gone up meaningfully, all the manufacturing has gone out of US. And on the other hand, if you look at China, where current account surplus has gone up meaningfully, still the currency has depreciated versus the US dollar, which defies all macroeconomic fundamentals. That they are looking to correct by depreciating the currency and by ensuring that these tariffs bring manufacturing back into the US, which will mean the brick and mortar companies, the manufacturing companies on the ground, those should start doing well, and tech, etc., should go into, and Mag 7 in particular, should go into a long slumber. And in that context, I would choose to look at the bigger picture, like the last 20 years and thereabouts, so that I get a picture of the next 5 years, rather than looking at a day where the frequency of volatility, etc., can be quite high. And in fact, just pleasantly, that offers me the right prices, because for the next 5 years, I see that emerging markets in general and India in particular will be a big beneficiary of the trend that we are seeing in the markets today, the macro trends. As regards the next 3 months, 6 months, etc., I would choose to look at the India market in isolation. And I think that on that count, the India markets the downside on earnings is behind us, the downside on liquidity is behind us. Both those aspects are favorable for India for the next 3, 6, 12 months.
Okay, hold on to that thought, Anshul. I'm just going to get back to you. Aditya, hi, morning. Good to have you on the show. Tell me, what would you want to, or rather be tempted to trade more today? Long on pharma or short IT further?
Very good morning. I think short on pharma could be a better trade because it's like buy on news and sell on buy on rumors, sell on news kind of thing, wherein the outcome on tariff was such it was better than expected, and on that news a lot of pharma counters came up but got sold off from the high. So I feel that the good news is out and discounted. So IT pharma short is a good trade in the near term. And if one has a view of more than 3 months, then I think even IT would be a tempting one in 1 or 2 days when volatility settles down. Because just see how a commodity market got sold off yesterday. It's like when the biggest uncertainty is out, gold is correcting, and now when the biggest uncertainty is out in terms of tariff, then IT stocks have got sold off. But this offers an attractive opportunity right now because now all the bad news is in the price. It will be in the price in 1 to 2 days, and if you look at the IT counters, then it's approaching its medium-term support. So in 1 to 3 days, I think IT would be a good buy, and today I think pharma could be a good sell today.
Okay. Uh, where is SGX? I look at SGX and I say, okay, हुआ ही नहीं है कुछ. But for how long will we be able to go against the tide? That is the point. I mean, to make a case, see, you will fall less, but you will fall. If US markets fall for another couple of days, today we are using the word decoupling, Anshul bhai. Soon we can start using the word recoupling. It looks all great. 2008 also looked all great. Subprime crisis, unki problem thi. Subprime crisis happened in America, but it eventually hit everybody.
I completely agree, Nikunj bhai. Although I must say in the same breath that subprime had excesses of a different order altogether. And when I see companies today and the aggregate of companies today, I don't see those kinds of excesses in their balance sheets. At that time, we had balance sheets riddled with debt and capacities getting added on debt capital. Today, capacities are being added on equity capital, and balance sheets by and large are clean and don't have debt on them. So the impact that we saw then is unlikely to play out today. One is that. Second, even in the US, of course, in the near term, this volatility will happen. But if you just step back and look at the tariffs, of course, it is a tax, but it is also a message. It is a message from the US establishment to all those countries on whom the tariff has been applied to come on the table and negotiate better terms. The markets over there are also telling you that these countries are bound to come back to the negotiating table with the US, negotiate for better terms, and then come to some sort of a middle ground. It's not like this is the be all and end all of what has happened. Also, we need to look at the person Trump and his past to understand what he's trying to do. He's a deal maker. He's someone who's a businessman. He's bringing people to the table. He's pulling them to the table. Just left on their own, they would have never come to the table. He's giving them a nudge. And on that count, I don't think that this tariff and also the fact that it has been spoken of so much should be feared. I think that this will settle in some time. Volatility, 2 steps up, 1 step down, that may continue to happen. But this is an event which has played out. We shouldn't fear it too much. I think that this will only offer better prices for us to buy for the next 2 to 3 years.
Good morning to you, Anshul. And yes, banks definitely the one that everyone is watching out for very closely, given the fact that it is a domestic-oriented stock. And the narrative right now is just that, focus on sectors that are actually mostly domestic-oriented. In that, do you think bank stands out? Also, does the HDFC Bank or the likes of SBI would stand out for you?
Good morning. Yeah, banking sector looks very interesting in terms of valuations and also the fact that there is very little international connect in the sector, that also holds well for the sector today. Now, if you look at the PSU banking space, you can throw a dart, pick a stock, and that will be trading at between zero point 0.5 and 1 time book, 5 to 10 times earnings. That is a recipe for very low downside and material upside whenever growth picks up. On the other hand, if you look at the private sector banks, the quality private sector banks, some of which you named, HDFC in particular, you look at the last 5 years performance of these banks, and you will notice that other than the last say 6 months or 8 months, these banks have consolidated and done nothing in price action over the last 5 years. In this period, of course, these banks have faced problems. Those problems seem to be behind us. One of those problems, recent problems for HDFC Bank, was their credit deposit ratio, which was really strained for them in comparison to the peers. And that seems to be assuaging as we speak. And these banks have enough capital to go out and grow. The Indian economy and the outlook for corporate India is quite strong, which means that there is that leg of growth which is ahead of the Indian economy and will translate into growth for these banks. And as a result, valuations being where they are, having halved over a 5 year period, look quite reasonable. So banking as a space does look quite interesting, and valuations are quite reasonable in this space.
Right, that's about the banking space. In fact, you have a note coming in from CLSA on Federal Bank, where they've initiated actually coverage on Federal Bank with an outperform rating. They've set a target of around 230 rupees per share. And they believe that now the bank is focusing on capturing low-hanging fruit over the next 3 years. They've also mentioned the fact that this is one of the oldest private sector bank in India, and they are pretty bullish on this one. On the other hand, you have IndusInd Bank that has been actually seeing some sort of a pressure, and UBS has come out with a note where they are actually maintaining a sell stance on IndusInd Bank, and where they're saying that yes, the visibility for the bank is pretty weak. Kunal, on the charts, any of these banks that you're liking, especially the private sector banks, and if you are looking at the private sector banks, would you look at any of the mid-tier banks?
Well, yeah, I think, the likes of Federal Bank, for example, that's something which looks attractive. IDFC First Bank, in terms of the risk reward, looks fairly, poised, especially at the zone of 50 to 55, where the stock has formed a major base for itself. City Union Bank is something which has come back into a breakout mode. So, from the private sector banking names, you have many of these stocks which have started to look attractive. And then even the PSU banking lot, if I can add that, there are many stocks which are now inching back or coming closer to their, breakout of the previous, 200 moving average highs. So once we see that also happening for many of these other PSU banking names, you might see this, basket also starting to perform pretty well. But I think all of this should be taken with, a zone that the markets are into a very strong round of extreme volatility, and so there could be a point where we may expect that these stocks may give you those breakouts, but those breakouts may fizzle out pretty soon as well.
Aditya, how would you approach the banks now? Aditya, how would you approach private banks now?
Yeah. So private banking space looks pretty attractive. Look at the large cap names like HDFC Bank, Kotak Bank, as Anshulji was saying, they haven't given returns since last 2 to 3 years. So after a very long period of consolidation, these stocks are breaking out. So I look them very positively. Although IT is correcting, it's the banking space, private banks, heavyweight banks, which are doing the heavy lifting for the market and keeping the index strong. So I maintain positive stance on two stocks in the private banking space, HDFC Bank and Kotak Bank. There's potential for more upside over here.
Okay. 2 minutes and then we'll get the first few minutes. By the way, China is flat. I have a limited point here that we know the peak of the ceiling rate, tariff ceiling. Now, whatever the final negotiation would be, it will be lower than what the ceiling rate is. Because when you see a $3 trillion shave off in US equities in just one day, it reminds you of dark days of 2020 when COVID happened. COVID was scary. 2008, that was a debt crisis blowing up and the system was at risk. Now when tariffs are at play, inflation will grow. When tariffs are at play, world will slow down. But nowhere I've read that, oh, the world is going to collapse. So what are the estimates? Because of tariff, 0.5% GDP goes down. Because of tariff, US has a 65% or a 70% probability of slipping into a recession. So it's not that this is the end of the world, and somewhere the US administration also understands economics much more than what all of us do. So they will also realize that there has to be a compromise. So iron fist and then olive branch is coming. And when that olive branch starts coming out, I think that start automatically as a trigger as to what the tariff would be. Nasdaq had become Humpty Dumpty. It was due for a fall. Gold has seen a 25% surge in last 1 year. I don't know why. It was due. Silver, I'm surprised with the selling, and Dow was always due for a fall. I mean, at the beginning of the year, US equity was 70% of the total market cap in the world, 60% of the total debt in the world, and 5% of the total population in the world. It was just getting too cozy to be true. But yeah, repercussions are there. Technicals are at play. Selling could happen. Those are factors which you'll have to deal with. I mean, you'll have to really bear what could be called as the painful adjustment in financial markets. It could last for days, it could last for months, I don't know. But yeah, painful adjustment is certainly around the corner. So Anshul bhai, what would you buy? 1, 2, 3, 4. What are those 1, 2, 3, 4 stocks you would like to buy every time markets are down?
Most importantly, I will buy stocks where earnings growth is not in question, or where earnings growth, because of the current tariff situation, will see a tailwind. I think that exporters of textiles to the US will see significant order booking, because tariffs on that segment for India have been far lower than competing countries like China, Vietnam, etc., even Bangladesh. And so I think that this is a space. Value retail, if you look at their results over the last 3-4 quarters, and even the initial commentary that they have given for the March quarter, value retail looks like a space which is seeing secular tailwinds in demand. And I think that this is a space which will be very interesting over the next 1 to 2 years. Also because this space or demand patterns squeezing down over the last, say, 2 to 3 years because of COVID, etc. Some capital goods companies have corrected by 50-60% and have come to valuations which are quite reasonable at this time, given the opportunity size over the next few years. I would really look at those plays. Within pharma, there is a very interesting opportunity. People are talking about CDMO as a huge multi-year opportunity. We are only $2-3 billion in a $150 billion global market. Now, even if 2-3% of that market shift to India because of geopolitics, etc., there will be a doubling of the Indian market size as a result. So you could either pick the best CDMO company that you think is going to do well, or you could look at equipment suppliers to CDMO companies, which will obviously benefit if the market size increases. And it's almost like if you're positive on autos, buy the tires. It's something like that you could play in the CDMO space. So these are some opportunities and segments which I'm very bullish on. And in my personal portfolios, we have been buying.
So those are a couple of sectors that Anshul is watching out for. On that note, thank you so much, Anshul, for joining us this morning to talk about the markets, the setup, as well as the sectors that are looking attractive at this point in time. Let's talk about the mid-cap ideas then from my experts. Aditya, you go first. What's your mid-cap idea?
Good morning. So my first idea is GMR Airport. So this is a buy at 82.70. 79 is the stop loss and 87 is the target. This stock is breaking out after a period of consolidation. So some more upside left over there. Second one from banking and NBFC space, IIFL. We have seen consistent outperformance from the finance space, and yesterday we saw good move on this counter. So this is a buy at 350.45. Stop loss is 325 and target is 376.
All right, so that is those are the mid-cap ideas coming in from Aditya.
If you like this video, then like, share and subscribe to ET Now.